Welcome to E-commerce with Coffee, a podcast powered by Amber Engine, where we share e-com secrets for brands over your favorite brew. We start with the caffeine and then leap enthusiastically into behind-the-scenes e-com insights that led to the success of our guests. I'm Nate Svoboda, and I'm about to serve you up the best. Let's get started. Welcome to today's episode of E-commerce with Coffee. Today, I get to speak with Sean DeClercq. He's the CEO and founder of Kickfurther, which is a platform that gives growing brands access to capital to help fund their inventory production with flexible payment terms and, really ultimately just makes that whole process easier. So today, we're really going to be diving into the marketplace model and how his team is applying that to Kickfurther. So Sean, welcome to the show.
Hey, Nate, great to be here. Thanks for the invite.
Yeah, no, I appreciate you joining us. Before we dive in, I think we'd mentioned this previously. Are you a coffee drinker? I see. Yep, there we go.
Right there.
So are you, what's your drink of choice? Are you a daily coffee person, multi-cups a day?
Yeah, I'll do usually 2 to 4 shots of espresso every day. I have a Breville at home and, in the office, just standard drip, right?
No, and that's fair, absolutely. I got into espresso a couple of years ago because, it's just the volume to caffeine ratio is so nice, right? You just
Exactly.
get the quick hit, help you get through the morning. It's a
And
little
it
bitter,
tastes good
but you can
too.
mix some stuff in.
Every once in a while, I think about that Conan sketch where he's got that producer that gets that fancy espresso machine just for him in the back, And I feel a little bit like that with my little home espresso machine, and I'm working from home, drinking my espressos, and everybody else is drinking drip in the coffee, in the office. So, but hey, you got to enjoy the little luxuries, right? Find the little things you enjoy. And
Hey, absolutely. Especially in this day and age when we're all working from home, right? You don't want to have to go out and buy coffee multiple times a week. Hilarious. Well, very cool. Glad, I'm a cold brew guy. I wish I had a fancy espresso machine. So a little jealous of you on that front. Well, Sean, diving into the meat of our conversation today. I already said that Kickfurther has to do with inventory funding, but can you give us an overview of Kickfurther, what specifically you and your team offer, and then, what types of businesses would come to partner with you?
Yeah, for sure. So real quick though, if you love espresso, you should check out the Breville machine. I don't work for them, but it's the best home espresso. So just, Breville home espresso maker, they're awesome. I got one for my parents this Christmas. All right, so
Okay.
Kickfurther, onto the real topic here. We provide inventory crowdfunding. So we have a marketplace model. On one side of the marketplace, we have individuals, family offices, small funds, high net worths that are interested in supporting entrepreneurs in America, right? And it's really broad and common. Everybody understands that inventory financing is this really tough space, really hard to get support as an entrepreneur when you're early on, right? And also really hard for the people that want to fund those entrepreneurs to be able to kind of compare apples to apples, right? And make sure that they're making good funding decisions and they're not putting too much capital at risk because, inventory for an early stage business is typically a relatively risky proposition, right? We have these funders on the one side of the marketplace and they want to support US entrepreneurs. They like the fact that these are backed by real physical inventory assets, right? And they also like that inventory is typically pretty high turn, right? If you invest in inventory, if you invest in physical inventory assets, you typically expect that you're going to be able to realize returns in, as soon as those things sell, which can be as little as 2 months, 3 months, 6 months, right? Almost in all cases, less than a year. So there's a bunch of reasons that people like it. And then on the other side, what we have are businesses, right? And the businesses have this classic problem. I'm sure, your entrepreneurs some of them have experienced this, where when you go and get a funder, right? Someone that's willing to provide funding for your business, they have this little area of the market that they operate in, right? Because they're borrowing their capital from somebody else at a certain rate. And that means that they have a floor on how cheap their capital can be. And the earlier you get in with them, right, their box is somewhere higher or lower, right? And then once you get to that floor, the rates just can't go down anymore, right? You can't get any cheaper than what their minimum rate is because they have to go pay for the capital that they're lending to you to some person that's providing the capital to them, right? And what that means is that as entrepreneurs scale their businesses up, right, what they do is they start here with expensive capital when they're small and risky. And as they grow, they keep adding in cheaper and cheaper capital down the chain, right? And it's this constant job for the leadership of any organization, right? Is like, am I optimizing my margins, right? Can I get more capital, cheaper capital? Because also the guys up here typically don't have big appetites. So, you go from getting 50K, 25K up here to 100K to 200K to 500 to millions, right? And it gets cheaper as you take more, is like this weird paradoxical thing, right? I guess not that paradoxical. So the beautiful thing with what we do is, because we work with businesses with as little as 150K of trailing 12 months revenue, all the way up to our biggest businesses are close to like 30, 40 million. We have a diversity. The funders on the other side love to come in early. You get to earn more profit, right? Because you're taking a bigger risk. And they also love to support those big mature businesses that only need 30, 60 days of inventory funding to get the AR, right? So we have this diverse pool, this marketplace of funders that are have very diverse appetites and attitudes. And what that means is that when we get in early with an entrepreneur, we can nurture them. And we've done this many times, all the way up to the point where they pretty much have the opportunity to exit their business to an aggregator, private equity, or whatever else.
So you just gave us a great overview of that. And, something I want to pull out that I heard, when you're a business, if you, let's say you get a relationship going with Target, right? You've had a trailing success record, and then suddenly this is like the biggest purchase order you've ever gotten. You need to give a down payment to the manufacturer that's actually supplying that product, right? And so if you are a small business, you may not have the cash liquid to actually pay for that inventory. So it sounds like, you're giving access to growing brands to this capital that's very flexible. And it's awesome because then it's, people who want to invest in these growing businesses and, dictate where their dollars are going.
Exactly.
Again, you gave us a great overview, but what ultimately started you down this path, right? Like supply chain or inventory management are huge components of any business, but what ultimately set you on this path?
Yeah, I was running a business doing exactly what the entrepreneurs that are currently on our platform are doing, which is, you find people that want to buy stuff and you're like, hey, will you buy this from me at this price? And they're like, yeah, I will. And then you go and you try and like make it at a lower price, right? Hopefully you have those relationships already. And then that's what, you buy for X, you sell at Y. That's the whole business, right? And then you make the margin in between that. And so I was running exactly that business. It was a wholesale products company. We were doing, our big seller was fiber optic Christmas trees for Midwest catalog retailers. And so we were selling these like 36-inch tall fiber optic Christmas trees. We did like 7 containers of them one year. It was like $300,000 of fiber optic Christmas trees, right? And
Oh, wow.
just to pay the deposit to start that production, right, I needed to put about like, so I was on a 30% margin, right? So think that like my cost of goods on that was about 200K, and I need to put 30% up deposit because I had a good deposit, right? So I need to come up with 60K of cash right away just to book my production slot. And then before they would release the inventory to me, I had to pay them another $140,000, right? So that's 200 grand to earn 300. And I had never gotten such a big order in my business at any point in the past, right? And I could fund $50,000, right? $100,000 was starting to stretch it, but $200,000 was just outside of my means as a business owner. And when I went into market, it was just ridiculous how expensive the capital was, right? Like we went to AR Factors, and the best rate I could find was a 5% discount per month for my receivable. And I'm on a 30% margin. So after you factor in the cost of overhead and all the other things, I went from having a profitable growing business to losing money on every single deal I had to finance, right? And to me, there was just this massive gap in the market because why would it cost my business 5% a month when I've got guaranteed sales? I have a purchase order. All I have to do is deliver on the inventory, which I've done many times in the past, right? And in the meantime, my bank account is earning nothing, right? Like 0.01% losing value to inflation every single day that I leave a dollar sitting in my bank account. It gets less and less valuable. And I'm like, how does this make any sense? That capital is both extremely scarce and expensive for growing businesses, entrepreneurs that need it, but valueless to depositors, right? Like, where's the market efficiency there? That didn't seem to make any sense. And so we said, we think that we've got a better opportunity to give people the opportunity to buy inventory, to start to participate in this retail chain, share a little bit in that experience with these entrepreneurs that need their support, and everybody wins, right? And we can be that layer in between those two.
It's interesting. Maybe I'm saying something that's super obvious, and I think it's profound. But so I see a relationship between like Kickstarter and Kickfurther, right? Is that intended? Is that something that you kind of did intentionally?
Well, it was, yeah, early on. Our name, still our corporate name is WeBuy, spelled OUIBY. Okay, so it's like that's terrible branding. We learned that early on, and then in very first accelerator, we had a guy that was like, oh, you're doing crowdfunding. That's kind of definitely one of the cool aspects of what you do here is you allow anyone to participate. So why don't you kind of look at opportunities to leverage some existing branding in the market, right? And I wouldn't say, I think Kickstarter is great, but the idea of like providing a little kick, a little boost, right, is like the same idea, and we want to take it further than just the start, right? We want to keep it going for these entrepreneurs on our platform.
Yeah, no, absolutely. Now, I personally have never heard of anything that sounds similar to what you guys are doing. So I don't, say first of its kind. I don't know if that's 100% true, but in my mind, it seems to be. I guess help me understand, the marketplace model, right? How is it put into the context of Kickfurther and being applied to? Is it more, about the investors or the funders that work on the platform? I guess, can you talk us through that?
Yeah, absolutely. So I have a slide for this in my investor deck, but I don't have that handy here. So just imagine here, the way everybody else works, right, is I have a bunch of clients, right? They want to borrow money from me, right? And they want to borrow at some APR of X, right? So let's say a standard APR in the marketplace might be 30% APR for small business lending. In fact, that's like a pretty good rate, okay? So I if I want to deliver that, I need to lend at like, I don't know, let's say what is that, like 2.5% a month, right, per month of finance that I'm giving out. And I'm borrowing from some bank at like, I don't know, 6% a year, right? And so the difference, I'm making that 24%. And then I've got some losses, right? So when the deals don't go well, like that's like 5% or something. And then I've got to pay my overhead, and then I've got my profit margin, right? So that's every other business is essentially what I said before, a buy for X, sell at Y, pretty much what they're doing, except what they're doing that with is money, okay? Now, the Kickfurther model, we don't buy for X. At no point do we incur capital costs. So it's not my funds that I am sending out into this marketplace. I don't have any relationships with banks. We're not balance sheeting any of these deals, right? So I don't have a borrow cost, right? What I have is I have gone out to acquire a bunch of people that have capital, and they want to support the people on the other side of the marketplace, right? And kind of like a very key fundamental difference here is that when you think about the other model, their goal is to lend at the highest possible Y, right? The money they make is I borrow at X, I lend at Y. The higher Y goes, the bigger, more money I can extract from my clients, right? The more money I make, the more profitable and smart of an organization I am. With Kickfurther's model, the beautiful thing is we don't set these rates, right? I don't have a borrowing cost. And actually, the way we work with our businesses, we have a subscription model. So we say we've gone out, we've done the work, we've built the credibility, right? To say, if you qualify on Kickfurther, we have a pool of funders that are very excited to support you, right? You will be able to get the funding because of the hard work we've done. And to access that, right, and to access our technology that's going to qualify you as a product business to get them to the level that they're comfortable with providing you the funding, you have to pay us a flat rate, right? And that varies depending on the trailing 12 months revenue of the business. So it starts, the super duper early startup tier is $400 a month. And then like the mature business tier is like $4,000 a month, right? And they pay us a flat rate every month, and that pays for our people and our technology to do the work, the bits going back and forth, qualifying the deals, packaging them up, right? And then the funders are making the decision. So we essentially qualify the businesses. It's a two-step process. We qualify the business and we say, we ran this business through our little mechanism, and we said this is a business that's more likely to succeed than any others. And then the business goes to the marketplace. They create their consignment opportunity is what we call it. And the funders decide whether or not enough profit has been offered, right? And they get the deal funded. So it's a two-step clearing process, right? One is more likely to succeed, good-looking business. Two is the risk is being priced through the marketplace at the right level. And what that means very specifically is when you have a balance sheet and things go wonky, it's really, really risky for you, right? So in 2020, when the pandemic came down, Kabbage and On Deck completely stopped originating anything, right, to their communities, and then they went away because their balance sheet risk went upside down, right? and they had to get acquired, but they completely stopped providing any funding when the pandemic happened. With Kickfurther, we were able to continue to qualify businesses and say, listen, it is a pandemic. Things are super weird, right? But these are still businesses based on our historical data that are more likely to succeed than not, right? And so we are going to put them up to the marketplace. And then the marketplace, it was fascinating. Literally in about a week, we went from funding deals at about 1.1 to 1.2% a month, jumped up to almost 2.5% a month in a week, right? Because there was a market shock, lockdowns, everything happened. So suddenly capital got a lot more expensive, but it was there and it was available to the entrepreneurs, but there was more risk in the market and that was being reflected on the marketplace, right? And this is a very long-winded way of saying that everybody else that operates as anything else than a marketplace model has a single point of failure, which is their underwriting algorithm, right? And that's based on historical data. If it goes wrong, their balance sheet goes upside down, it blows up the entire business, and literally it's an existential risk. They just go away, right? Or they have to sell at a major discount. With Kickfurther, we don't have a balance sheet, right? And so since it's not our capital, there is no chance that we can get blown up due to some kind of market shock, right? So we have a much more resilient business model, and the key, and it's like, oh, well, that makes sense. Why doesn't everybody do that? Because guess what? You make way less money with a marketplace model than if you're the one that's collecting all of the payments from the business, right? If that's going straight onto your balance sheet, in the short term, you make a lot more money. In the long term, you carry this existential risk, right? And so we made the difficult decision 7 years ago to say, we're not going to do what everybody else in the market is doing, right? And we're not going to optimize for short-term profit, even though that is easier. And even though there's a lot of market pressure for us to do exactly that, we're not going to. We're going to do this thing that's harder, that has bigger long-term, that is a bigger long-term opportunity and creates more value and a more efficient market for every player involved, right? It's harder, but the outcomes are greater. And so that's what we decided to do.
Yep, and that last part is what I was going to sort of touch back on. Is it sounds like, Kickfurther's incentive in this relationship is to be the intermediary of the value exchange, right? So to your point, it's not your capital. You don't have a skin in the game as to what the lending rate is. You are just giving access to the people who need the funding and the people who want to fund. So I love that. That's awesome. Now, I won't ask you to give away, your secret sauce. I'm sure part of this is the onboarding, the vetting process you go through. But, I'd imagine that there are certain sets of entrepreneurs or projects that, you just can look at and say, you know what, I believe that one is going to be pretty successful or above the average. I guess, what are some of those telling signs or things that, you've started to see as a trend, if you can share any?
Sure. So I would say, what's interesting, Nate, is that there's such a wide breadth in the market. Okay. So it's like when you look at these guys, we have some really, really successful companies that are running thin margin wholesale businesses. They're like 18% margin selling water, right, to supermarkets and stuff like that, right? And it's like, oh, if you have enough volume, that can be a very successful business. So, but as I understand it, you've got your crowd is a little bit more entrepreneurial. So what I've seen as being very successful within, let's say, new upstart companies or people that are really cracking into the market, because those legacy water distributors, right, have big market share and it's tough to unseat them, right? So how are new people winning, right? How are those the people coming in and making big impacts? It's typically the stuff that's pretty high margin and pretty niche, right? So it's identifying something that you can do well to serve a market that well, right? And then you solve some problem, make sure you charge a good margin for it, right? If you're e-commerce, you should have at least a 75% margin. That keeps wholesale open for you, right? So those are that's the one thing that I will say is true, is that you should have at least, if you're selling direct to consumer, a 75% margin, right? That means that you can then sell wholesale at a 50% margin, keep your minimum advertised pricing consistent, right? And open up a lot more distribution and volume, which you can then use that to negotiate with your suppliers to reduce your cost price as you're buying in greater quantities, right? So that's the typical path is identify a problem, solve it better than others, have good margins, open up wholesale, increase volume, leverage volume to negotiate discounts, scale, sell the business to somebody else.
I love that. We could just make that a bulleted list. I'm sure you probably already have it as a bulleted list, but that should just be in the show notes.
Yeah.
It's interesting. At the beginning of the show, and you just reiterated it again, you said a good business plan for a lot of these companies or these brands is, identify the market that has, a good fit for you, attack it aggressively or go after it aggressively. And then, the big guys may not necessarily want to compete with you. They may just try to buy you out, or you have a successful following. The marketplace model that you guys have at Kickfurther sounds like it really helps to bridge that gap for smaller businesses so they can compete with the bigger guys. But I guess, are there other nuances to explore? I mean, that can't be a catch-all, right? What are some of the challenges that you still see these smaller companies facing and competing?
Oh, I mean, so one of the things that's really key there is charge a lot. So charge high margins, because one of the classic mistakes I see entrepreneurs do is they're like, oh, if I sell at this super low price with a 30% margin, I can get customers. And it's like, nice, yeah, great, but guess what? You can't scale that well, right? Like it just gets more expensive. So it's like, you are creating a lot of value in the market if you can earn a 75% margin, right? That's just like an easy measure of how much value you're creating for your customer is how much they're willing to pay you for it, right? Compared to what your costs are to deliver it. And so that's a piece of it. And then, the question of, are there any other things? I mean, yeah, sure. Like, for instance, if you're a bigger client, right, and there's a whole bunch of supply chain disruptions going on, you might be able to lean on the freight forwarder to say, you better make sure my container makes it onto that ship, right? Whereas if you're only buying one container every 12 months from that freight forwarder, you probably don't have as much leverage, right? And like, these are old school industries, right, that are still pretty arcane and still pretty like, who knows who, and like, it's just old school business, I would say, in a lot of it. And so there's a lot of leverage like that I know, I'm sure it gets applied behind doors, behind closed doors kinds of things for the bigger players, and just makes economic sense for the service providers in between. Manufacturer discounts, it's still really, really tough to get to the kind of quantity discounts that any of the big players can play in. That's just the truth. But I think a lot of the rest of the world is evening up, right? The ability to reach your customer is so much easier now compared to the way it was in the past. So like, I think the ability to compete is actually so much more real and much stronger today. And what you're seeing now is like, I would almost argue like the Johnson and Johnsons of the internet, right? So Johnson and Johnson became this brand where they just like snapped up anybody that was like starting to encroach in their market share. So now what you have are these like guys that are trying to be Johnson and Johnson for e-commerce, right? Like the Thrasio, the SellerX, the Perch, right? And so there's all of these exit opportunities that are really, really interesting for product entrepreneurs that exist today, that didn't really exist in the past, right? And I think that that's another like kind of, there's more demand, right? And still the supply of people that are able to build a business is still low. And so prices have gone up, and that's great for the entrepreneur.
No, it's interesting, right? I completely see what you're saying with that. Now, one thing I wanted to go back to, because you mentioned it and I almost forgot to ask you about it. You talked about there being, tiers to the marketplace model. So like the funders can come in and, I guess, I don't know if the tiers apply more so to the fundees or the funders, but can you talk us through, if someone comes in and they want to start funding businesses through Kickfurther, are there sort of levels to the relationship that they can have? Does that give them access to, different investment opportunities? Can you talk us through, how you built that model out?
Sure. So the tiers that I was referencing, there's about 5 tiers for businesses that are gated by what their trailing 12 months revenue are, right? So our goal here was, look, my business, when I encountered that issue, was like 600K a year or somewhere like $1 million a year, right? So in our scale, we were a small business. So we've always intentionally said we want to be able to serve the entrepreneurs that need this the most, right? The funny thing is, the more money you're making, the more people want to give you money, right? But the big problem is the earlier in the chain. So we always wanted to make that available. Obviously, those guys are pretty price sensitive. And so if you've got only like 500K or 300K of revenue, I forget the exact tiers, but you can start working with Kickfurther at a 90% discount, $400 a month, right? That's like really low cost of capital for those businesses. And then that scales, we have 80% discount, 70%, 60, at 50%, 25, and then 0, right? So those are all the tiers for businesses, gated on how much revenue they earn. And then for the users, there's really only 2 tiers. So there's our regular free user, when the deals go up on the platform, you can pick how many packages of inventory you want to buy, right? And you get access to the deals as they go live on the platform, which is after a 24-hour upcoming funding period. And then what we have are, effectively, like we're rebranding this right now, but let's just call them, for the sake of this conversation, premium users. And those premium users have committed capital to Kick Further. They get access to allocating and putting their buying inventory in the upcoming period. And they pay us a little bit for that right to buy during upcoming.
Okay. Now, do most of the funders come to you just organically? They find Kick Further, or, I guess, what is the breadth of, capital that comes in, right? Are most of the deals sitting around like 25K, or some of them, higher? I'm curious what the stretch is there.
Yeah, I mean, it's one of those things I find super fascinating. So it's everywhere, right? We just actually funded our first $1 million first deal. That just went down this week for a company called Macris, $992,000 or something like that, but pretty much $1 million. And our smallest deal will be about $12,000, right? So there's a very wide breadth. The biggest deal we've done is, I want to say, 1.3 million, but it's around there, right? So that's about the current upper limit is in around a couple million here, right? I would say we could probably push the envelope on a 1.5 million deal for a good business today. And then, as little as $112,000 of inventory.
Wow, that's awesome. And that's especially awesome because it just goes to show the variety of businesses that you guys can help, right? So I love that. Well, Sean, I guess.
And the variety of funders that are on the platform, right? There's very different people that want to buy that $12,000 deal than the $1 million deal,
Oh yeah, and I would imagine that it's probably not primarily like VCs, right? Like it's, people that have money that want to use their dollars to dictate, what products or up and coming businesses are going to succeed, right?
Yeah, exactly. I mean, I would say it is we do have a good amount of funds coming from high net worth individuals, and kind of small funds are participating on the platform. And they're very meaningful contributors to the marketplace, right? They give us the ability to bring on these much bigger businesses, that are really looking for very competitive cost of capital, right? And so they give us the opportunity to expand into the market and make those opportunities available to the rest of the community, right? So we really are building out a very diversified marketplace on both sides of the marketplace. And I think that that's going to be important for our long-term success.
Absolutely. And it's especially interesting. I know it doesn't have anything directly to do, right, with crypto or Web3 or any of that kind of stuff, but you hear about the concept of decentralization, and I see a lot of parallel with what you guys are doing. So I definitely agree. I think that the trend on that is only going up.
Yeah, for sure.
There was some, what you said?
I said there are some thoughts there about how we can maybe make a splash in those areas too. But right now we're happy to have our little centralized solution.
Nope, absolutely. Well, Sean, where can people get in touch with you if they, either want to get access to capital through the marketplace model, or they have some funds that they want to invest in some businesses?
www.kickfurther.com should provide the onboarding for both. So whether you're a business or you'd like to be a user and support businesses, please come by. Or find us on Twitter or Facebook or wherever else. We're all over the internet.
Awesome. Cool. Well, Sean, this has been a fantastic conversation. I appreciate you joining me, and I look forward to talking to you again soon.
My pleasure. Nice to chat, Nate. We'll talk soon.
That's it for this episode of E-Commerce with Coffee, powered by Amber Engine. If you haven't gotten your fix yet, be sure to get more e-commerce brand secrets on our website at amberengine.com. And don't forget to subscribe for more episodes.